The secret behind every market move: impulse and correction. Have you ever looked at a chart and thought, okay, the market is going up. Then suddenly price drops. And immediately you start thinking, wait, is the trend over? A few candles later, price explodes higher again. And now you're confused. You buy late, you panic early, and somehow you're always one step behind the market. Here's the problem. Most traders see movement. Very few understand structure. Because every move the market makes, every trend, every rally, every crash, is built from only two things: impulse and correction. Master these two concepts, and charts start making sense. Ignore them, and the market will look random forever. So let's break this down. Let's start with impulse. An impulse is the aggressive move, the powerful move, the move that actually pushes the market somewhere new. In the market, impulse is the moment one side takes control. Buyers take over or sellers take over. Price moves with strength. Candles become larger. Momentum increases. And the market starts breaking previous levels. When buyers dominate, the impulse moves upward. When sellers dominate, the impulse moves downward. Simple. But here's where most beginners make a mistake. They think every candle matters. It doesn't. The market doesn't care about individual candles. The market cares about movement. And impulse is the movement that creates progress. Now let's talk about correction. And correction is where most traders get trapped, because correction looks scary, especially when you're new. Imagine price is moving up aggressively. Buyers are in control. Everything looks bullish. Then suddenly, price starts falling. Red candles appear. The market slows down, and fear enters the room. Many traders immediately think the trend is reversing. But often, nothing is reversing. The market is simply correcting. A correction is a temporary move against the current direction. Not a reversal, not a trend change, just a pause, a breath, a reset. Now, here's something important. Corrections are not weakness. Read that again. Corrections are not weakness. They're actually healthy, because a market that never corrects becomes unstable, and the structure would eventually collapse. Corrections provide balance. They allow the market to absorb previous movement. They allow buyers and sellers to reposition, and they create opportunities for the next impulse. That's why experienced traders often get excited during corrections, while beginners panic. Professionals see opportunity. Beginners see danger. Same chart, different understanding. Now let's connect impulse and correction together, because this is where market structure comes alive. A bullish trend is not just price going up. A bullish trend is a sequence. Impulse up and correction down. Impulse up and correction down. And each new impulse pushes higher than the previous one. That's how trends grow. Not in a straight line, but in waves. Markets move in waves. Always. Even the strongest trends don't move straight up. And even the strongest downtrends don't move straight down. Everything happens through cycles. Expansion, then pullback. Expansion, then pullback. Now let's talk about why understanding this matters for entries, because this is where traders lose money. Most beginners buy during an impulse, not near the beginning, near the end. They see big green candles, they feel excitement, they fear missing out, and they jump in, exactly when the move is becoming exhausted. Then what happens? Correction starts, price pulls back. And suddenly they're in drawdown, not because their analysis was terrible, but because their timing was terrible. They entered at the wrong phase. A few traders often do the opposite. They identify the impulse. Then they patiently wait for correction. And only then do they start looking for opportunities. Why? Because corrections often provide better risk, better entries, and better reward potential. Patience becomes a weapon, not a weakness. Here's another powerful insight. Not all impulses are equal, and not all corrections are equal. Strong impulses usually show conviction, momentum, urgency, and aggression. Weak impulses often struggle. They move slowly, they fail to break important levels, and they can signal a weakening trend. The same applies to corrections. Some corrections are shallow, some are deep. The key is not memorizing patterns. The key is understanding behavior. Ask yourself, who is in control? Who is losing control? Who is pushing? Who is resting? When you start thinking like this, charts stop being random pictures. They become stories. Stories of buyers and sellers fighting for control. So next time you open a chart, don't ask, is price going up or down? Ask a better question. Am I looking at an impulse or am I looking at a correction? That single question can completely change the way you trade. If you enjoyed this video and learned something valuable, make sure to subscribe and turn on notifications. And remember, the market rewards those who understand the story behind the candles, not those who react to every candle they see. See you in the next video.